Welcome to my channel. I'm Scott, and in this video we're going to talk about accounting. What is accounting? So the high-level definition, according to Investopedia, it's the process of recording financial transactions. Also summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. Just a little tip, I learned more from Investopedia than I did in all my undergrad and college. And I learned more on YouTube than my MBA courses. So it's just that simple. It's collecting and organizing financial data for individuals and organizations. We do accounting all the time. Say, for example, you have a budget for your Christmas gifts. You list out all the people on a piece of paper or maybe on an Excel spreadsheet. Then once you get all the names on a sheet, you increase some amounts, you decrease some amounts. You may have to add some people, remove some people. This is accounting. And it doesn't matter what you do with the list. You're not regulated by anyone. To take it a step further, I know some people list all their expenses, all their assets, what they own, their home, their car. They list all their debts. This is also accounting. It's a little more difficult than just keeping a simple Christmas list. To take it another step further, there's accounting for big corporations that is regulated. And there's some accounting information only internal people can see. So if it's your Christmas list, only you can see it. If you're a private company, only the person who owns the company and the accountant can see it. If you're a public company, you have to report certain information to the public. And if you're a private or public company and you want to get a loan, then you may have to provide additional information to get that funding. There are four main areas in accounting. The first is bookkeeping. Without bookkeeping, everything else is irrelevant. Bookkeepers input the data. They record transactions as debits and credits. You might see credits as CR, which makes sense. Credit starts with CR. And you may see debits as DR. But why does debit say DR? Why doesn't it say DE? Well, DR is short for debitor, DEBITOR. CR is short for creditor. The bookkeeper has to record all the information into a general ledger. This is just a book that gives you each transaction, and it may keep a running balance or possibly a closing ending balance. And then all that information in the general ledger is used to populate financial statements. It may also be used to create internal reports. If the CEO wants specific information about the company, he can just go to the bookkeeper and request it. But most of the information in the general ledger is not available to the public. Let's pretend we're in the 1950s. If a company buys supplies with cash, say they buy pens and pencils with cash, they have to document that transaction into a daybook using journal entries. They have to record all the cash inflows and outflows. When the company pays rent, the bookkeeper has to record that into the daybook. Then the bookkeeper has to record all the transaction into the ledger books. If it's a cash transaction, they have to record it in the cash ledger. If they sell a product, they have to record that in the sales ledger. It doesn't matter if they receive cash or they sold on credit, they have to report it in the sales ledger. I think of the ledger books as a finalized version of the daybook. A business can have as little as 5 ledger books or hundreds. You can have one sales book for all your sales. You may have 20 sales books. Maybe you have the US sales book, the Europe sales book, the Africa sales book. You break it down by region. Or maybe you have a sales book by product. You have the typewriter sales book if you sell typewriters. You may have the ink sales book if you sell ink. Of course, if you're a small company, you may just have one sales ledger. A company always starts with a journal entry and then it goes to the ledger books. And if it's a small company and they only have 2 or 3 transactions a day, they may record it in both books at the same time. If it's a really big company and they have hundreds of transactions, maybe at the end of the week or end of the month, they record everything into the ledger books. It's really up to the company or the bookkeeper on how they want to record the transactions. As long as all the transactions are recorded and they're correctly recorded, that's the most important part. Then at some point, the company gets all their ledger books and copies every single transaction into the general ledger. And this general ledger is huge. It could be thousands and thousands of pages. All the information about the company is in the GL. Then just the balance for each account is put into the trial balance. Say it's the first day of 1951 and we want to report on 1950 financials. And cash at the end of 12/31/1950 is $10,000. In the trial balance, we want to put $10,000 for cash. Each account shows up on the trial balance. The trial balance makes it easier to identify errors. If debits do not equal credits, there's a problem. And it may take the bookkeeper 10 minutes to fix the problem, or it could take them an entire week, depending on how difficult the problem is to identify. And then all the reporting comes from the trial balance, the income statement, the balance sheet, and all internal reporting. Maybe the manager of the warehouse asks the bookkeeper, "Let me see all the purchases we've made in the past 12 months. I want to see if we're over or underpaying for something." But as an investor, I can't ask the company for that information. The only information I get is what's publicly reported. I can ask for more information, but they probably won't give it. So for thousands of years, it's been done with paper, bookkeeping by paper, or some form of paper. And then recently, within the past few decades, everything changed. It's now on computer. I used QuickBooks for my accounting software, but there's dozens of other options out there. By using a computer, it reduces the amount of errors and it saves so much time. In the 1950s, a big corporation may have thousands of bookkeepers. Fast forward 30, 40 years, maybe one bookkeeper or two bookkeepers. All of those ledger books are now put into QuickBooks. Every single account is contained within 5 categories: assets, liabilities, equity, revenue, and expenses. The first 3, assets, liability, and equity, are part of the balance sheet. The balance sheet has to balance. Assets have to always equal liabilities plus equity. Revenue and expenses are part of the income statement, but at the end of every accounting period, the income statement is zeroed out and net income is put into retained earnings. So the income statement is part of the balance sheet. It's the equity or the net assets. Let me show you an example of how it looks on a computer screen. Pretty much every single accounting software in the US uses the same structure. Assets start with 1, liabilities 2, equity 3, income 4, expenses 5. And the accounts are always 4 digits long. So cash is in account 1100, inventory is in account 1150. When I did my QuickBooks, my checking account was 1000, my savings account was 1001, and liabilities always start with 2. All your payables start with 2. Maybe accounts payable will be 2000. If you're new to accounting, you may look on the balance sheet and see unearned revenue in the liability section. And you may think to yourself, revenue shouldn't be a liability. So you may get confused and think it's in the wrong section. But if you looked at the software, you would never be confused, because if it starts with 2, it has to be a liability. If it starts with 1, it has to be an asset. And then retained earnings starts with 3. You have dividends, additional paid in capital, treasury stock. You might have common stock. And then income starts with 4. This looks like an example of Facebook. So 4120 may be mobile sales. Say that's 1,000. There might be a plus next to this 4120, and you hit the plus and it's a drop down. You see 4121, mobile sales from Facebook, 100. 4122, mobile sales from Instagram, 25. So you might have sub-accounts or sub-ledger accounts, because a company may only report revenue on their financials. If you had access to their accounting software, you would see a ton more detail. Some companies provide more detail. Some companies list how much revenue by country, sometimes how much revenue by product. But according to GAAP, generally accepted accounting principles, they only have to report certain information. They could provide as much as they want, but you don't want to give out too much information because your competitors may take advantage of that. Expenses starts with 5,000 and it goes up. So expenses could go into the 6,000s, 7,000s, because expenses tend to have the most accounts. If you buy from Amazon, then it's 5231 Amazon. If you buy products from Costco, it may be another account, 5232. And every time you buy from a new vendor, you have to add an account. Since most of the people watching this video are investors, financial accounting is what you're most interested in. It mainly focuses on 3 statements: the balance sheet, income statement, and statement of cash flows. To add more confusion, it's not usually called the balance sheet. Sometimes it's called the consolidated balance sheet, or the statement of financial position, or the consolidated statement of financial position, or the statement of financial condition. The list goes on and on. But don't worry about the name, look at it. If there's assets, liabilities, and equity, it's the balance sheet. Income statement is the same thing. Some companies call it the profit and loss statement. You may see the consolidated income statement or the statement of operations. All you have to do is look at it. If you see revenue, expenses, and net income, it's the income statement. And the financial statement most people don't talk about is the statement of cash flows, which I feel is the most important of the 3. A company can have positive earnings, positive net income, and lose cash flow. How can that be? Maybe they're selling a lot of items on credit. If they're selling items, they're receiving revenue and booking the revenue on their income statement. Revenue increases your net income. But if their customers didn't pay them anything, they'll pay them in the future, then their cash flow may look negative because they didn't receive any cash even though they're reporting all this revenue. A company can report a big loss on their income statement, a negative net income, but have lots of cash flow coming in. Maybe they pass through a large impairment, like a goodwill impairment. They wrote down the value of an asset they purchased in the past. That's a non-cash item, so it makes your net income look really bad, but it doesn't affect cash flow. And these statements are used by the owners of the company. Even though the owners of the company can get all the detail they want, it's a lot easier looking at numbers that are summarized. Lenders, if you ask for a loan at the bank wants to see your balance sheet, income statement, and statement of cash flows. If you're a private company, you have to still provide that to the bank. Even though you don't have to provide that information to anyone else because you're a private company, but if the bank requests it, you have to give it to them. If you don't, they just won't give you any money. And the bank may ask for more information. They may ask for more detail on your revenue. Even though you don't have to publicly report it, if the bank asks for it, you have to give it if you want that loan. And the financial statements are used by analysts, like at JP Morgan or Goldman Sachs, so they can tell everyone their price target and write a report about the company. And it's used by rating agencies. Rating agencies rate companies. They don't rate stock, they rate their bonds, their likelihood of paying back their debt. If they're a AAA rated company, like Microsoft, then they could get a loan from anyone and pay a really small interest rate. If they're rated single B, then not many people will lend to them. And if people do lend to them, the company has to pay a really high interest rate because they're a high credit risk. Any company below BBB is considered junk rated or below investment grade. And then the stakeholders, people who have an interest in the company, want to see these financials. Like me and you, if we own stock in a company, maybe the suppliers, because they want to make sure they're going to receive money if they're going to sell products to the company. Also, the employees have an interest in the company, because if the company goes under, they may lose their job, their pension, and maybe other things as well. Financial accounting is highly regulated. In the US, a company has to follow GAAP, generally accepted accounting principles. This makes it easier to compare companies. Although within GAAP, a company can manipulate things. Different depreciation methods, for example. But a company can't go way off the course. They have to stay within the GAAP structure. And there's many countries that use IFRS rules, International Financial Reporting Standards. The section we're talking about is financial accounting, which is info that's sent to outsiders. It's public info. The next section we're going to talk about is managerial accounting, which only certain people can see. The third area of accounting is managerial accounting, which is only available for insiders. But insiders can share this information, like for instance with Warren Buffett if they want to get his investment, or with a bank if they want to get the loan. But of course we know it's illegal to trade on inside information. And this type of accounting is much more detailed. You can get all the information you want. You could get pricing information. You can see sales by country, sales by vendor. You can get all the detail you want. So it's used by management to make key business decisions. And the nice thing about it, there's no accounting rules. You can request this information from your bookkeeper in any format you want. So if you wanted to get a loan from a bank, you can modify the information. Of course, you can't lie. Lots of companies use data mining or massaging the data to make it look better than what it is. But a company does not want its competitors having this information, because if Pepsi had access to Coca-Cola's managerial accounting information, then they could adjust things like their pricing, or maybe different places they sell products to try to get a leg up on Coca-Cola. So having all this detail helps improve the quality of the information, the quality you report externally and internally, because maybe a manager for a certain department may identify some errors and then relay that to the bookkeeper. You could identify every cost in the production process to try to become more efficient and more profitable. You can see as much detail you want. You could see how much rent you paid per month. You could see how much you paid in phone bills. Maybe something as simple as how much money do we spend on pizza? We do Pizza Fridays every single week. How much are we spending? We're spending $10,000 a year? Well, my friend owns a pizzeria and he'll do it for $8,000. The goal of having all this information is for the company to increase revenue, reduce expenses, because the goal is to maximize profits. The last area of accounting is tax accounting. This part of accounting focuses on taxes rather than the appearance of the financial statements. The tax accountant doesn't care how the information is presented to the public. They just want to make sure the taxes are correct. So it's a subsector of accounting. A company has to prepare tax returns and make tax payments. Once you understand accrual accounting, it's kind of like having two sets of books. You have your regular sets of books that everybody sees, and then your tax books. Because the IRS may require double declining depreciation while the company uses straight line depreciation. So the value of a building on the company's balance sheet may be $1 million, but for tax purposes, the building may be valued at $500,000. Tax accounting is very technical and complex. And to make it even more complex and confusing, it varies a lot by industry and location. The way a US company and a UK company calculates taxes is different. And the way two US companies that are in different states, because they're state taxes, calculate taxes different. And two companies within the same state that do the same exact thing may have different accounting methods. If one's a for-profit, one's a non-profit. In the United States, the IRS dictates all the accounting rules. If you own stock in a Mexican telecom company, an example is ticker AMX, then they use the Mexican tax rules. That's the SAT, Servicio de Administración Tributaria. So to summarize, what is the purpose of all this work? Well, you need to record the information, then you're able to analyze it to make better business decisions. Then you can report the information internally and externally. If you're a public company, you have to report it. If you're a private company, you don't have to report it to anyone unless you want funding from a bank or an investor, then you may have to provide them the information. And it's a way to communicate to the world how your company's doing. So the 4 areas of accounting are bookkeeping, which is the first step, then financial accounting, which is what we care about, managerial accounting, which is for insiders, and tax accounting, because everybody has to pay taxes. I'm going to post these slides on my Patreon channel, so if you're a member, you'll have access to it. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.